Foreclosure filings increased 21% year over year. So we're going to be diving into some of this data in this video, and I want to kind of give my opinion, my expertise as to why this is occurring. I'm a realtor. I've been in this profession for quite a while now, and I noticed a trend back in 2022 and the following years that make me believe a reason as to why foreclosures are climbing and likely continue to climb over the next couple years. So this article is published by Adam. The data comes from Adam. It's a company that tracks a ton of housing data. It's very, very expensive. I don't pay for it. They do publish some free articles every now and then. I'm not affiliated with them whatsoever, but I do like to check out some of the free stuff that they are putting out. And essentially, they have come to the consensus that low down payment purchases are one of the primary reasons as to why foreclosures have been increasing and why they're up 21% year over year. And I noticed this trend happening in 2022, 2023, as well as 2024. And I'm going to talk about that shortly. But first, let's read through this a little bit. So 227,000 foreclosures happened in the first 6 months of this year, up 21% during the same period in 2025, and up 28% during the same period in 2024. Not only that, but REO completions increased by 33%. Now, foreclosure is the pre-REO. REO is when the bank takes ownership of the home and then they in turn sell it. Foreclosure, the bank hasn't yet taken ownership of that home. In this video, we'll also look at the top 10 states where foreclosures are happening more frequently in terms of the number of units, number of foreclosures per housing unit. But first, let's talk about my opinion as to why this is occurring. Why are foreclosures going up, and why are they likely going to continue going up over the next couple of years? By the way, we are nowhere near the levels of 2008, so that's just not even a conversation to have, and I'll get into that shortly when we look at the top 10 states. But during 2020 and 2021, we had the lowest mortgage rates in history. People were getting 2.5% loans to purchase a home. And that is not really something that was ever seen before. Heading into 2022, the Fed raised interest rates at the fastest pace in history. Mortgage rates went from 2% to 7% in like 6 months. And as a result, the housing market was kind of in a standstill. So what happened? Well, mortgage brokers needed to, come together and figure out how can we get people into homes. A lot of low down payment purchasers, people who are doing 5%, 10%, FHA, VA loans. A 7% mortgage rate is a very, very high monthly payment. So they reintroduced something called a 2-1 and 3-2-1 buy down. Now a 2-1 buy down is essentially, let's say you qualify at a 7% mortgage rate. A 2-1 buy down will give you a 5% rate for the first year and then a 6% rate for the second year. And then you go to your 7% in the third year. Now, that's fine. A lot of people do this. However, what was being sold to a lot of these low down payment buyers was that you're not ever going to have to touch the 7% mortgage rate. You're going to have the opportunity to refinance way before this happens. So people were sold the idea that they were going to be able to really have this 5% mortgage for quite a while. Worst case scenario, it would get to 6%. Because the general consensus amongst the mortgage industry is that mortgage rates were not going to remain elevated for long, and the Fed was going to cut rates, and mortgage rates would go from 7.5%, 7%, whatever they were, to 5.5%. So they were selling buyers, a lot of first-time home buyers, the idea that, I'm sure everyone has heard the term, marry the house, date the rate. That is where this came from. Find a house you love, get a temporary rate buy down, and then you can refinance into something lower within the next couple of years. Well, we all know that didn't happen. Mortgage rates are, at the time of recording this video, around 6.7%, so they haven't really dropped. So buyers did not really have an opportunity to refinance. So a lot of these buyers, by the way, I saw a lot of this. I am a realtor in Southern California, and I saw a lot of mortgage brokers pushing this temporary rate buy down idea, 2-1 rate buy down, 3-2-1 rate buy down. And a lot of buyers were coming in with this notion that they were really going to be able to have a 5% mortgage rate for the foreseeable future, because they thought worst case scenario, they'd have, maybe 6 months of a 6% rate and then they could refinance. So mortgage rates remained elevated, as we know. And in fact, right now, the Fed is in a position where they potentially raise interest rates. Now, that will be a discussion for another video, but we are definitely by no means in a scenario where mortgage rates are going to plummet anytime soon. So we're still not in an environment where these homeowners who bought with the idea that they wouldn't have a 7% rate for a long time are still not going to be able to refinance anytime soon. We have oil causing inflation spiking. We have the unemployment rate still at historic lows, around 4.2%. So the Fed is definitely not in a position to cut rates at all, really. In fact, if you go on my website in the description below, there is a rate cut monitoring tool that will tell you what the likelihood of rate cuts, rate hikes, or neutral rates are for the next Fed meetings. And right now, it's pricing in 2 rate hikes before the end of the year. But anyway, so a lot of these buyers got these temporary rate buy downs in 2022, 2023, and 2024. And when they came to the realization that mortgage rates are not going to give them a refinance opportunity, they just got stuck with a higher mortgage rate. So, there are a lot of these buyers who are doing 5% down, mortgage rates going from 5 to 7%. That monthly payment is huge, coupled with insurance policies going up, HOA is going up. If you're in a condo, Florida is, we'll get into that in a minute, but Florida is going through an insurance and HOA crisis right now, which is likely leading to an increase in foreclosure activity as well. So these temporary rate buy downs were great, at the time, but fast forward 2 years later, they're stuck with a 7% mortgage rate, no refinancing available, unfortunately. So that is what I saw a lot of in 2022, 2023, and 2024. Not so much last year and this year. I think there are some, temporary rate buy downs happening, but most people are just opting for 30-year fix. They're tired of waiting for potential mortgage rates to lower in the future. They're over it. So I'm not seeing too much of that right now, but 2022, 2023, that was really a very, very popular loan instrument to get buyers into that home. And obviously we're in an economy where, wages haven't kept up with the overall cost of living. So when all of a sudden, 2 years later, average cost of living is going up, your everyday expenses are going up, gas prices are higher, and then you have your mortgage payment higher, going from a 5% rate to a 7% rate, a lot of people could get themselves into a situation where they just can't afford that house anymore and go into foreclosure, and then maybe just choose to rent something after that. But that is my opinion as to why we're seeing foreclosure activity increasing year over year since 2024. I'm curious to know your thoughts in the comments. So let's get into the top 10 states where foreclosure activity is the most common. So number 1 is Florida. 1 in every 2,100 housing units are in foreclosure. Like I said earlier, Florida is going through an HOA and home insurance crisis right now. A lot of people bought a condo with maybe a $4,000 monthly payment, and 2 years later, you have your HOA has doubled, your home insurance has doubled or even tripled in some cases, and now you're looking at a $5,500 monthly payment. For a lot of people, that $1,500 jump is going to be unaffordable. Now, just for reference, Florida, yes, it is the number 1 in foreclosures, and yes, it historically is the number 1 in foreclosures, but during the 2008 financial crisis, it was 1 in every 300 housing units that were going into foreclosure. So 1 in every 2,100 is significantly less than the financial crisis. And that's why I wanted to reiterate that we are not really looking at that at all anytime soon. Maybe if this 21% increase year over year continues for the next 8 years, then potentially we're in a situation where, we could have home values dropping significantly as a result. But I think it's just going to be very localized. And if you're in Southern California, I'll touch on specific foreclosure data for cities in Southern California shortly. But you can check out this, adamdata.com. It'll show you the top 10. Number 2, South Carolina. Number 3, Indiana. Number 4, Nevada. Number 5, Illinois. Number 6, Delaware. 7, Ohio. 8, Texas. Now, Texas doesn't surprise me to be in this top 10 list. Texas itself has had, sort of like a mini housing correction going on. Some places have seen home values drop 15 to 20%, and that's primarily driven by investor activity. A lot of investors bought, $300,000, $400,000 homes, thinking they could just turn them around, rent them very quickly for $3,000, $3,500 a month. And you can do this yourself. Go to Redfin, go to Zillow, look at rental inventory in the major metros, and inventory for rental units has skyrocketed. You have homes sitting on the market for 90, 120, 150 days, dropping their rent, their available rental price every month, and they're still not getting rented. So investors are likely one of the causes why Texas is in the top 10 for foreclosures. California, obviously, California is having a massive insurance crisis right now. There was a huge fire that, devastated communities, displaced homeowners, and caused $50 billion worth of damage. Understandable why California is in the top 10. What is already an unaffordable market has been drastically more unaffordable because of insurance issues. Insurance companies have left California, and the ones that stayed have to increase, by 30, 40, 50, 60% just to make up for the additional insurance premiums. And number 10, North Carolina. But that's kind of it for the, overall foreclosure data. If you are interested in checking out foreclosure data across Southern California, you can head to the link in the description below, themarketvector.com. This is a platform I created. I am tracking housing data across 190 cities, 5 counties in Southern California. And this is an interactive map. You can download reports here with the premium version, get them sent to your mailbox every month. Check out mortgage rate data. You can see the Fed rate hiking odds heading into the end of the year. October, 60% chance of a hike. December, 71% chance of a hike. But, and there's also some historical, going back to 2008, some data here for you as well. So on the interactive map, you can really just click any city you like. So we'll go Los Angeles just because it's a very popular one. And we can see foreclosure activity, which I started tracking in June. So this is the June numbers, and then I'll update the July numbers by the end of this month. 243 foreclosures, 45 REO inventory. So this is 45 homes being sold by the bank. So LA, obviously a big city, understandable, 243 foreclosures. It's 1.1% of the overall available homes for sale. And then if you go to a place like Irvine, there's probably no foreclosures here or very little. Yeah, 5 foreclosure filings here. There is also some economic data on this platform as well. Crime rate, school performance, home ownership rate, that sort of thing. So if you want to track some markets yourself in Southern California, head to themarketvector.com. If you like this video, subscribe for more. Normally, I just talk about Southern California specific markets, do some deep dives. But every now and then I like to do a broader economic video because it all does relate to local housing markets as well. That's it for the video. If you enjoyed, subscribe for more, and I'll see you next time.